Welcome, everyone, and thank you for joining us for this very first episode of the Hops and Ledgers podcast. This is brought to you by Beer Guys Radio and Wipfli CPAs and Consultants. Hops and Ledgers will focus on the business of launching and operating your craft beverage business, featuring quarterly episodes on a variety of topics to help launch and grow your business. I'm Tim Dennis with Beer Guys Radio, and I'm joined by Pat Tuley of Wipfli to host and guide these discussions. In this first episode, we'll also be joined by Terry Hoover, a Wipfli SBA specialist. With that, I'll turn this over to Pat to tell you more about Wipfli, his areas of specialty, and our discussions today.
Great. Thanks, Tim. And we're excited to kick off this series of podcasts with Beer Guys Radio. And they'll air over the next 12 months on a more or less a quarterly basis. The Hops and Ledgers. Our firm Wipfli is a national CPA firm with offices across the country with a dedicated team and services targeted to the craft beverage industry. We are dedicated to our clients' successes. This Hops and Ledgers series will feature innovative and strategic initiatives underway at craft breweries focused on the business of beer, and we're excited to sponsor this series in conjunction with Beer Guys Radio. We will bring you experts in a variety of areas and talk with brewers to share perspective and insights about the ever-changing business of beer. We'll talk about expansion initiatives, trends in the industry, collaborations and branding, mergers, acquisitions, combinations, and roll-ups, how you value your business, raising capital, and many more topics of interest to craft brewers. We look forward to getting these topics underway, but like all of us, we've been a little busy lately with social distancing and the enormous disruption that has occurred as a result of COVID-19. We look forward to covering all of those topics mentioned previously and sharing business insights with you in the near future, but thought it would be much more timely and relevant to kick off this series with a look at COVID-19 and how we can best position our breweries for survival and success.
Well, Pat, thank you for that information. Definitely a hot topic. We've been talking about several great topics to discuss over this next year, and this one just kind of unfortunately came up on us. As we're talking to our brewer friends out there, of course, everybody's extremely concerned at this time. It's impacted the hospitality, brewing industry, restaurant industry extremely heavily, and a lot of our brewer friends are extremely concerned about what the immediate and long-term future holds for them. So, Pat, what are you hearing from your clients, and what are some resources that are available to these brewers?
Sure. Well, the first thing that we're hearing in the immediate reaction is obviously that it's having a severe impact on our breweries, no matter whether they've been in business for 6 months or 6 years or longer. People are wanting to be strategic about where their business will come out on the other side of this, but there is certainly an element of survival that plays into this to make sure that we do the right things so that our business survives. We've heard through our media and a lot of other things that this is war. So what we're hearing from breweries, though, and as we're talking with them, is their focus remains the same. They're focused on their customers and employees, obviously the survival of the breweries, and their communities that they operate in. So, I don't think that focus changes. At the top of that list right now, on a very positive note, breweries are first and foremost concerned about public safety for their customers and for the communities overall. So we've seen a lot of breweries that have closed their tap rooms as a social setting, whether that's been mandated by the state or local governments or otherwise, just out of a concern for public safety. Following very close behind that is maintaining great relationships and helping their employees to get through this process. Obviously, the ability to meet financial obligations for the brewery survival are important as well. So, making loan payments, making lease payments to your lessor, other fixed costs that you have, whether it's utilities, working with vendors. So, a lot of things that require, a lot of liquidity, a lot of cash in order to keep the business going, to try to take care of your employees, to try and service your customers. So, what we want to talk about is, kind of what are we seeing in terms of how are breweries responding to this? How is the government responding to this? What assistance is available? Are there any strategies that we're seeing deployed across our craft brewery niche that are helping the breweries to be in the best position going forward. So, Tim, you mentioned Terry Hoover is joining us. He's a partner in our Wisconsin practice and has worked with a number of our breweries and is here today. Terry also specializes in small business administration lending. And so one of the key things that we've heard over the last 2 weeks and really over the last week or so with the latest stimulus bill is a lot of interest from our brewers about the new Small Business Administration, the SBA lending initiatives. So we're seeing that borrowing capacity is going to be very important through the SBA or other mechanisms. That's been at the top of the list with these discussions. So we're going to have Terry take us through the expanded lending programs that were part of the CARES Act that was signed into law last Friday. So Terry, I'm going to let you take over from here.
All right. Thank you very much, Pat. Here in Wisconsin, we're now on day 17 of what our governor had termed the Safer at Home order. So we are enjoying working from home. By reference, I'm located about 30 miles from the headquarters of Breeze Malting, one of the epicenter businesses in the craft brewing industry. And so we have great admiration and affinity for the industry and a number of service points, including Breeze and others. If I could first take you back in time a bit, hard to believe, but on March 13th, of this month, the president declared a national emergency in the United States, one of the first times ever for this type of situation. What that triggered then was each state having its own ability to then declare its state as an economic disaster area. And that culminated in the SBA announcing on March 17th that it had waived all of its normal disaster declaration requirements. And so effectively, every state in the union now is eligible immediately for all economic stimulus, traditional economic stimulus that the SBA had to offer. But beyond that, we watched closely last week, culminating in Friday's signature by the president of the CARES Act, which enabled an even more rapid deployment of urgently needed aid to small businesses. The CARES Act, the centerpiece as it relates to small businesses, is referred to as the Paycheck Protection Program. It wisely uses a robust network of the SBA and all of its participating lenders throughout the country. Virtually every banking institution, credit union, and specialty lender that was previously enrolled as a participating lender is now elevated in status to a preferred lender, meaning that if they meet the fairly minimal documentation requirements that we'll talk about in a bit, they have the authority to approve and process the loan, hopefully resulting in a disbursement within a matter of days from application. This is unprecedented in the annals of the SBA, and we expect that upwards of about $350 billion will be dispersed under this new SBA 7A loan with a very unique forgivable provision. But first, in terms of eligibility, the eligibility has been broadened essentially to cover any small business, operating business of 500 employees or less, and that's counted on a per employee basis without regard to full or part-time status. But virtually any small business is eligible so long as they had employees on payroll as of this past February 15th. In addition, the net was thrown even wider. Some 501c3 nonprofit organizations are eligible, as are tribal business concerns and even veterans organizations that previously had no access to SBA financing. There are special rules for those who might be part of an affiliated group where there's common ownership that perhaps takes the employee count beyond 500 employees. There are some carve-outs and exceptions. Interestingly, for our audience here, for those with a business code of 72 under the government's business classification, which essentially covers lodging, hospitality, food and beverage retailing and catering services. So in the event someone is part of a larger affiliated group, there still may be the ability to qualify for a loan despite the fact that the group itself might be over 500 employees. Congress was very intentional too about including all of the self-employed, so sole proprietors, the self-employed, independent contractors are all considered eligible small businesses under this provision.
So Terry, for the businesses that get approved for these types of loans, what can these funds be used for?
Sure, Tim. The theme here is Congress is trying to make this very easy to get to the application window. And so they've essentially laid down a formula by which an employer that has been in business essentially for all of the last year will take a monthly average of their gross payroll costs, and we'll speak about what's in payroll in a moment. But that monthly average over the prior 12 months leading up to the date of the loan times 2.5. So effectively 2.5 times one's gross payroll is the borrowing limit. Plus, for those who might already have had an economic injury disaster loan outstanding at this time, there are some in the marketplace, those are eligible for refinancing as well. But effectively, it's one's gross monthly payroll over the last year times 2.5 up to a maximum loan limit of $10 million. With that, then, the payroll costs that can be included are all of the typical things we would think about in payroll: gross wages, bonuses, commissions, overtime pay. But it also includes employer group health benefits, retirement plan contributions, things like 401k matching, and all state and local payroll taxes that might be assessed, things like state unemployment taxes or the like. Unfortunately, federal FICA payroll taxes are not includable in that payroll cost calculation for purposes of maximizing your borrowing base. And for those individuals who are earning more than $100,000 a year, essentially on an annual basis, that's the cap at which their compensation can be included in the payroll cost calculation base. As an aside, some employers have already taken advantage of the expanded sick leave and expanded FMLA tax credit subsidized pay that can be offered to those who are either diagnosed or caring for a diagnosed person, or who cannot work because of work at home orders or schools being closed and the like. Pay to those people cannot be double counted in terms of being able to increase your borrowing base under the PPP, the Paycheck Protection Plan. Once the maximum borrowing base has been determined, the funds can be used once they're drawn, and they will be dispersed in one lump payment by the bank, by the lender. Those funds can be used for a number of allowable purposes. In addition to paying those payroll costs that we just calculated using the 2.5 times the monthly average, there's some flexibility here. A business owner who needs and wants to make a rent payment in order to avoid default on a lease, or who has interest on other debt obligations that were outstanding as of February 15th, they have some flexibility, and they can choose to marshal some of their loan funds to pay those what are called covered obligations, as well as utility payments. Think heat, light, power, cell service, internet connection, and the like. Those are all eligible expenses for the use of the loan proceeds. And we think that's powerful because, again, you have some ability to marshal your funds where you think you need them most. In terms of the forgiveness aspect of the PPP loan, again, this is unprecedented. I've referred to it often in talking with clients as this is really a government grant that's wearing loan clothing. And how this grant function and loan forgiveness will work is that after June 30th, when the loan forgiveness period has essentially ended, during the 8 weeks prior to that, so think basically the month of May and June, any funds that you've expended for payroll costs, as we've defined them, as well as interest on debt that was in place before February 15th, payments on rent or payments on utilities, all of those costs that have been dispersed are effectively subtracted from the balance of the loan. And if it zeroes out the entire loan, so be it. The entire loan is forgiven. In terms of the tax considerations for that forgiveness, Congress has explicitly stated that unlike any other situation where a loan is forgiven that can create taxable income, it does not do so here. So it's effectively a government subsidized grant to cover those covered costs. There are a couple carve-outs wisely included in the law by Congress. In terms of compensation to someone earning over $100,000 a year, prorated on a monthly basis, the maximum that they can be paid on an annual basis is $100,000 during this 8-week period. And get forgiveness of that portion of the loan proceeds. So Congress doesn't want borrowers to fund basically higher compensation employees at the cost of having enough funds to cover everyone else. So only the first $100,000 for all employees, not just owners, only the first $100,000 annually is includable in the forgiveness calculation. As I said, too, qualified sick leave wages or expanded FMLA pay can't be double dipped here. It cannot be part of the forgiveness quotient in this PPP loan. And also for those who have employees whose principal place of residence is outside the U.S., compensation to them is not a forgivable expenditure. Congress also has inserted a couple sort of carve out and take back rules, if you will, to again encourage the use of these funds for continuity of pay for one's employees, to the extent that there is a drop in FTEs per month. Between what one had for FTEs prior to the COVID-19 crisis and what one has for the period February 15th through June 30th of 2019, if there is a drop in FTEs, then that percentage drop is the percentage drop in available forgiveness. So in other words, if we had, let's say, a 10% drop in FTEs during the 8 weeks post loan draw, compared to what one had prior to that, prior to February 15th, then there would be a 10% reduction in the forgiveness that would be permitted under the loan. Again, the encouragement is to try to stabilize and maintain the workforce as best we can.
So Terry, a question for you on that real quick. So I know, unfortunately, there were some breweries that as soon as these closure demands came to them, there was immediate layoff or furlough of employees. So would that impact these loans, or is it only reduction in FTEs after a loan has been applied for or originated?
That's a great question. And Congress, again, in trying to encourage stability of the workforce, they've built in basically a callback exception where if employees are called back to service, even if they have to be furloughed because they, in their particular state, they may be under a work-at-home order, and if they're not considered an essential business, depending on their function, such as in the tasting room or other retail services, if they're furloughed as opposed to laid off and they're compensated, then you get relief from that part of the FTE calculation. So there's opportunity here to call employees back, albeit on a furlough basis as opposed to laid off. That can be beneficial, and it lets the borrower basically keep as much of this forgiveness potential as possible. In addition to that, Congress wants to prevent, significant pay cuts during the 8 weeks post disbursement here on the loan, and so they've set a threshold basically of 25% and this is tested on an employee by employee basis for everyone who was in that sort of payroll cost bucket that allowed us to draw the loan dollars. Should anyone suffer a larger than 25% pay reduction during the 8-week period compared to what they were earning prior to February 15th, then those dollars in excess of 25% are reduced from the potential forgiveness. So this does provide some flexibility, though, we think. And again, Congress is trying to allow everyone to make decisions about what is the most important bills they need to pay. It's conceivable that something less than a 25% reduction in pay could be offered to employees, especially those that are furloughed and not able to work. That difference, then, those dollars can be freed up, if you will, for paying necessary rent and utilities, with the entire expenditure still being forgiven at the end of the loan. So, but to the extent that an employee earns less than 25%, or I'm sorry, more than 25% of a pay cut versus their earlier compensation, that excess then will cut into the forgiveness capability. There are a number of other collateral effects, I would call them, of participating in the PPP. For example, you're not eligible, if you draw a PPP loan, you're not eligible for the employee retention tax credit that's available under the CARES Act. And quite frankly, our belief is, for the large majority of small businesses, accessing the PPP with this potential for full forgiveness is a much more powerful tool. And so typically that is where we think borrowers are going to first go. But to the extent they do, there's no double dipping with the, basically it's a 50% of pay tax credit that's available otherwise under the CARES Act. Likewise, the emergency injury disaster loans that were created, the economic disaster loans, should a client or a borrower borrow under the PPP, they're not eligible to borrow under the economic injury disaster loan program for the same costs. So there's no double dipping of payroll, if you will. There are other bases and other uses for the EIDL loan, but borrowing for payroll is prohibited. There's also, for those who might have a current SBA 7A loan outstanding, and hopefully you've already heard about this from your lender, but the SBA has stepped up by virtue of Congress and will pay the next 6 months of the scheduled payments under any existing SBA 7A loan that's in place. And that does not prohibit one from borrowing this new PPP loan if you currently have a 7A loan in place. So we think that's a very favorable situation. Many potential borrowers ask, well, what about things like collateral, personal guarantees, personal financial statements? In the past, there's been a can I borrow elsewhere standard that has to be met in order to qualify for a 7A loan. Congress has done away with all of those. So there are no collateral requirements, no personal guarantees. There is no recourse against the business owner for the balance of any balance of the loan that might not be forgiven. There are no fees that are chargeable to the borrower. The SBA will pay a modest fee to the participating lender that originates the loan, but it's essentially a fee-free, cost-free structure and opportunity for the borrower. In addition to that, we often hear questions about, well, what if I somehow haven't been able to spend my entire loan draw by June 30th? And I suspect this is an unlikely case for many small businesses. In the unlikely case that should happen, the balance that is not forgiven can be termed out then for up to 10 years at a maximum interest rate of 4%. And we understand that might go down in the future. And payments are suspended for a minimum of 6 months to as many as 12 months for a payment holiday. So we view it as very favorable long-term debt going forward in the event that all of the funds aren't forgiven and there is some balance left. That, by the way, continues to be 100% guaranteed by the SBA, so we think it's extremely lender-friendly. The requirements that the SBA has placed on the lenders here, as I mentioned earlier, are quite minimal in terms of loan documentation. And by great coincidence, about 3 hours before we began our broadcast today, the SBA released on its website their initial application form for the PPP loan, as well as some good kind of common sense reads of how the programs work. And so I can tell you, if you go to home.treasury.gov/cares, you'll find the application form and a number of white papers that describe the programs, both from the borrower and the lender perspective. The window opens, if you will, on April 3rd is the first date that participating lenders will be able to take and process applications. Our understanding right now, talking to the lending community, is that they are anxious. We expect there will be undoubtedly a crush of applications, and so we're advising clients today. The things that one needs to do is, if you've not already done so, please talk to your lender and confirm that they are a participating SBA lender and that they are prepared to receive applications. Begin to assemble the documentation that you will need. It is fairly minimal at this point. Essentially, payroll tax records over the past 12 months showing what your gross payroll is, documentation of your expenditures for health insurance, other forms of compensation, payroll taxes, state and local payroll taxes, all of those things that make up the borrowing base. You'll want to start assembling those right away. For those who aren't quite sure how to proceed with that, we think that turning to one's trusted advisors is certainly a wise thing to do. As I see it, we have really one good shot here to maximize that loan request. And so we want to make sure we're extremely diligent about uncovering every dollar that we can use to throw into the bucket, so to speak, to multiply times 2.5 to reach the maximum loan draw availability. With that, I thought I might speak just briefly about the EIDL loans, the Economic Injury Disaster loans. As I mentioned, there's a no double dip provision, if you will, so we cannot apply for that loan in order to fund the payroll costs that we would otherwise fund with this PPP. But there are still other good uses for the EIDL loans. The loans are that are available are up to $2 million. They can be used to pay other fixed debts, to refinance existing debt, to pay trade vendors and other obligations that you haven't been able to pay because of the COVID-19 crisis. Really, the only exception for eligibility for expenditure for those loans, as I said, is anything that you would otherwise pay through the PPP loan program. These loans are a little different in that they are accessed directly from the SBA on its website. Participating lenders do not take the applications for these loans. So the SBA website will direct you to a portal where you can easily start that application process. They promise a response within 3 to 5 business days, and with any good speed, funding within about a week to 2 weeks thereafter. Our urgent plea to all that think they are eligible is to move quickly to contact your lender if you've not already. We think there will certainly be some logistical issues with the number of applications that a particular lender might receive, and so you want to be at the window as early as possible, so to speak.
Excellent. Well, Terry, thank you so much for that information. It's as you mentioned a little bit earlier, just before we got on to begin our recording here, some new information came in. So this is definitely something that is it's an constantly evolving process. So, definitely check with your financial advisor or contact Wipfli. They'd be glad to answer these questions for you. Now, you are listening to the Hops and Ledgers podcast, brought to you by Wipfli LLP. Wipfli ranks among the top 20 accounting consulting firms in the nation for nearly 90 years. They have educated, advised, and assisted clients in the successful navigation of complex and ever-changing business environments. Today, the firm works with more than 150 craft breweries across the country and also provides services to a wide range of adjacent industries, including manufacturing and distribution, construction, real estate, and agribusiness. Whether you're a startup brewery or looking to expand your current operations, Wipfli can help turn your dream into a successful reality. Learn more and find your local office at wipfli.com. That's WIPFLI.com. Now, Pat, in addition to the loan programs that Terry told us about, what are some other options available to brewers?
Sure, Tim. Some of the so outside of the loan program, the other thing that we've seen that's gotten a lot of traction, again, kind of going back to that pecking order, is we want to do everything we can to take care of our employees and to make our employees safe. So the bill that Terry has just been talking about and all the SBA provisions, that was part of the CARES Act that was signed last Friday. A little over a week earlier, we had Congress sign and Congress develop and the president sign the Families First Coronavirus Response Act. This was the second bill, if you will, that came through, and it's got some additional provisions to kind of help employees out in a little different light. So I'm going to cover some of those real quick. Family First, there are two main provisions of the Families First CRA, and those are meant to, the first is, and Terry referred to it as the Emergency Paid Sick Leave Act. And secondly, there's the Emergency Family and Medical Leave Expansion Act. So the way I look at these two provisions, the first one, the Paid Sick Leave Act, really deals with employees that are either themselves sick or having to take care of somebody as a result of COVID-19. And the Emergency Paid Sick Leave piece of this covers really the first 2 weeks of an event. So I'll talk a little bit about that first. The emergency, well, let's do this. The second part of this then is the Emergency Family and Medical Leave Expansion Act, and it typically picks up then from weeks 3 through 12. So in terms of covered employers and employees under the Emergency Paid Sick Leave Act, it covers certain public employers or private employers with fewer than 500 employees, tax-exempt organization with fewer than 500 employees, and employees of the federal government. So, broad, it meant to be something here again with the under 500 employee limit to benefit small businesses. It covers all employees. So the emergency paid sick leave, again, so this is the first 2 weeks. This covers all employees of covered employers and are eligible for up to 2 weeks, 80 hours of paid sick time for specified reasons related to COVID-19. And we'll talk about that in just a second. So each may use paid sick time beginning, this bill is effective starting April the 1st. So the leave cannot be carried over to 2021. So depending upon their need for this leave, it starts April 1st and goes through the end of this calendar year. Sick leave benefits can be used for either full or part-time employees. If you're a full-time employee, you're going to calculate an average wage base for the time leading up to when you took your leave, and you can receive up to 80 hours of paid sick leave. If you're a part-time employee, you basically receive the equivalent of the number of hours that you would have otherwise worked on an average during an average 2-week period, and that's what you would get over that same 2-week period. The qualifying reasons really fall into two categories, okay? And there's like self-care and then family care. So the 6 reasons, the first category is if the employee themselves is subject to a federal, state, or local quarantine or licensed isolation order due to COVID-19, or they've been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, or if the employee is experiencing symptoms of COVID-19 and seeking medical diagnosis. So, again, if you are symptomatic and you've gone to see a doctor or are trying to seek medical attention, you would qualify under the self-help. And for self-care reasons, if you qualify for one of those things, reasons 1 through 3, if you will, the paid sick leave is at your regular pay, 100% of your regular pay, capped up to $511 per day, or over the course of a 2-week, 80 hours, $5,110. So a generous benefit there that the employees would be eligible for. Employers would pay that. The other reasons for emergency paid sick leave would be if you're caring for an individual who is either subject to an order described in the first categories. Okay, so somebody else that's quarantining or self-quarantining. If you're caring for the employee's child of any age whose school has been closed, or the place of care, so their daycare has been closed, or if you have a daycare provider that is not able to come to you to take, those are all caring capabilities that you would be covered under the Leave Act. Or if you're experiencing any other substantially similar condition specified by the Secretary of Health and Human Services in consultation with the Secretaries of Treasury and Labor. So those other categories, 4, 5, and 6, are what we refer to as family care reasons. If you qualify under one of those for leave, you're then paid at 2/3 of what your normal rate of pay would have been as a full-time or a part-time employee. And then that is capped at $200 a day, or for a full-time person over 2 weeks, $2,000 in total. Okay, so those are, again, a couple of provisions that are new. We'll go back to. I'm going to talk about some tax credits, but similar to what Terry was referring to in the PPP SBA program, basically the government will provide credits under this, that these leave allowances that we're talking about, while the employer would pay those, they would get a tax credit that basically the government is going to fully reimburse those amounts up to those dollar limits that we talked about. But we'll talk a little bit more about those credits in just a minute. In terms of notice, if the leave is foreseeable, an employee should provide notice of leave as practical. And after the first workday of paid sick time, an employer may require employees to follow reasonable notice procedures so that that they should continue receiving that. So once again, everything I just talked about, emergency paid sick leave, that's the first 80 hours, the first 2 weeks of leave, either for self-care or for caring for others. Now we move into the part of the same Families First CRA bill is the emergency expansion of family medical leave. Here, covered employees, similar group, public employers, private employers with fewer than 500 employees, tax-exempt organizations, and the one kind of different criteria here is that in order to qualify for this, the employees must have been employed for at least 30 days. So that is an additional requirement. However, if an employee was laid off by the employer no earlier than March 1st and had previously worked for the employer not less than 30 of the last 60 days and then gets rehired, they could meet the 30-day employment requirement. And there is a possible exemption for this. So, again, this typically applies to employers less than 500 employees. If you have less than 50 employees, you can apply for an exemption so that you don't have to, have the burden as a small employer. How you will apply for that exemption is still being determined. So, this expansion of the Family Medical Leave Act, this is eligible for weeks 3 through 12. And again, this one is the eligible employees. They may take this leave because the employee must care for his or her child who is under the age of 18 and whose school or place of care has been closed or is unavailable due to the COVID-19 public health emergency. So this is more the family care, caring for others criteria. Self-help is not eligible for this emergency expansion of the Family Medical Leave Act. The benefits, how are the benefits approached? So a qualifying employee, again, can take up to 12 weeks of leave in conjunction with the emergency paid sick leave and this expansion. After the initial 10-day period, they fall under the expanded family medical leave. There are additional provisions that require that you be restored to your previous position. Again, a lot of information on this on our website. I won't go into all of that here, but I do want to touch on there are tax credits available to the employer. So basically, the employers will receive 100% reimbursement for paid leave pursuant to the Act. So that's under either the emergency paid sick leave or under the expansion of the Family Medical Leave Act. If you pay benefits to your employees under those acts, they are 100% eligible for a 100% credit. In addition, that the reimbursement can include, or the amounts paid to your employees can include health insurance costs that are included in the credit. On these benefits that you pay to an employee, they are not subject to payroll tax liabilities. So that is a benefit on the employer side. Self-employed individuals can also receive an equivalent credit. The reimbursement takes place for these credits as you generate the credits, rather than remitting your full, if you've got other employees for which you're doing federal withholding on and have to remit payroll taxes. The way the credit mechanism works is that it would offset that tax remittance that you'd normally have for payroll taxes with the IRS. If you have excess credits, then they're eligible to be refunded immediately. So you shouldn't have to wait very long to realize the benefits and to realize these credits. So, there's a lot of the rules related to this. Again, there's a lot more information related to this, these leave benefits and the credits associated with those. What I'd like to turn to next are a few provisions in the CARES Act that don't deal with the SBA lending. So, Tim, this is going to be a little bit of a lightning round. I'm going to try and go through these fairly quickly. The first thing on this, this bill was signed last Friday. There are portions of it that have various effective dates. The first part I want to talk about is, as we are all aware, the IRS and the administration have delayed federal tax deadlines. So the actual tax returns that would have otherwise been due on April the 15th are extended out now through July the 15th. Previously, the administration had announced an extension of any payments that would have otherwise been due on April 15th as well. So in tandem between these two announcements, we have both the filing of the tax returns and the payment of any taxes that would otherwise be due by corporations, individuals, or trusts that would have been due on April the 15th. Those are now extended out until July the 15th. And if you need an additional extension, typically you could request a 6-month extension of your April 15th deadline out to October 15th. If you still need an extension in July, you can basically get an additional extension at that point. We're not clear on whether that's an additional 6-month extension. In all likelihood, that's at least another 3-month extension out through October the 15th. Recovery rebates. So this is another provision in the bill that's gotten a lot of press. So recovery rebates, these are the direct payments to all Americans. This is the benefit that's going to be paid out. And who are eligible? So U.S. residents who are not a dependent of another taxpayer are going to be eligible under this. The rebate is basically $1,200 per individual. For single taxpayers, if you're married, you would get a $2,400, basically $1,200 each for both spouses. There are some phase outs for that depending upon your adjusted gross income. There are additional rebates of $500 per child if they're under the age of 17. So at any rate, there's a few extra provisions there and we've seen that those checks are expected to be going out here just in the next couple of weeks. It will be based upon your it'll be based upon your tax return filings either for 2019 or if you haven't filed yet for 2018. But the credit will ultimately be based. It's an advance of a credit that or a payment that you will get, and they'll be calculated in conjunction based on your final 2019 filings. IRS has already indicated that if you were for some reason to get an excess advance payment, you don't have to pay that back to the government. If you don't get a payment now because of your income levels from your 2018 previous filings, but it turns out that you are eligible based upon your 2019 tax return filings, then you would ultimately receive that benefit with your 2019 filing. So a very popular provision there. And again, we expect to see those checks going out here in just in the next couple of weeks.
And Pat, is there anything that individuals need to do to get those, or is that just automatic based on the tax filings?
It's going to be automatic. So they're going through right now. Anybody that's that has filed tax returns, has a Social Security number, and seems to be otherwise eligible, that the IRS will be mailing those checks out. Their Treasury will be mailing those checks out.
Excellent.
Good question. Just in these, now we're going to run through the rest of these fairly quickly. If you're looking for funding, so again, a lot of our small business clients, a lot of our craft breweries are just, as we stated at the outset, looking for cash. What's other ways that we can get cash? The bill allows for early distributions from your retirement plan. These are available if the individual spouse or dependent is diagnosed with COVID-19 or the pandemic hurts their finances, such as through layoffs, quarantine, or reduced hours. It only applies to distributions made in 2020, but to the extent that you get a distribution as a result of one of those two factors, the distribution that would normally be subject to an excise tax would not be subject to that excise tax, and any tax associated with the income, with the distribution and early distribution from your retirement plan can be spread out. That can be spread out and paid in the future. So, a good provision there would be the income attributable to these distributions would be taxed ratably over 3 years beginning in 2020. So again, take out the money today, kind of bridge that gap from a financial standpoint, and then the tax that would be owed would be paid in 2020 through 2022. Or you could, before December 31st, 2022, you could actually put that money back into your retirement plan, basically as a rollover recontribution, and would not be subject to tax then on that. The bill also allows, the act also allows for retirement plan loans, and a lot of retirement plans already have these provisions where you could borrow against your own 401k or retirement plan, but there were limitations. You couldn't borrow more than $50,000, and no matter what the amount is, it couldn't be more than 50% of your vested balance. The Act allows now for the next 180 days, beginning with the enactment of this bill, that you can borrow up to $100,000 or the lesser of $100,000 or 100% of your vested balance. So, again, a generous provision there that would allow people to maybe access some cash that they otherwise wouldn't be able to get to. Switching gears to some other business provisions, as Terry mentioned, there is an employee retention credit. So to the extent that you're paying employees, and you would be eligible to take a credit equal up to 50% of their qualified wages. So, a provision there, certainly as, 50% credit isn't as good as 100% grant under the Paycheck Protection Plan, the SBA program that Terry described earlier. So, but again, here's kind of a fallback position depending upon your particular circumstances. The employer payroll taxes that would normally be due, the 6.2% Social Security tax or self-employment taxes that would normally be due from the date of enactment through the end of this year, you can actually defer those and not have to remit those to the government. Any deferrals would be, you would pay 50% of that amount by December 31st, 2021, and the other 50% would be paid in through by December 31st, 2022. So basically a 2-year free loan, if you will, of the employer payroll taxes. So that's a generous, again, another cash preserving mechanism in the bill. There were some modifications to the net operating loss deduction rules. So as a result of the Tax Cuts and Jobs Act that got passed at the end of 2017 and became effective for 2018, if you had a net operating loss, it was only able to be carried forward. Under the Act, net operating losses arising in the tax years 2018, 19, or 20 can be carried back for back 5 years. And by the way, you may have been in a higher tax bracket prior to the Tax Cuts and Jobs Act, so you could basically go back. The 80%, there is an 80% limitation as a result of the Tax Cuts and Jobs Act that under this CARES Act is being waived, so you can basically offset up to 100% of your taxable income with these net operating loss deductions. So again, if you had if you were just getting started in 2018 and had some operating losses on the individual side potentially, and those pass through to you from your LLC, you might be able to carry back even 2018 losses and go and recover some taxes paid in prior years immediately, even before all the financial impacts of the coronavirus, and certainly to the extent that you have any 2019 and 2020 net operating losses, those can be carried back up to 5 years. So again, a good opportunity there to recover some taxes. There is a similar provision, or a provision for pass-through losses that would have normally left not allowed for excess deductions in excess of $250,000 for a single taxpayer or $500,000 on a married return. Those limitations are being waived under the CARES Act as well. Last, there are a couple more things. There are some limitations on business interest expense that came into effect with the Tax Cuts and Jobs Act. Those have been liberalized under the CARES Act. And there's actually, we've actually heard from some brewers and some other folks in the spirits industry that have converted some of their operations into making alcohol to be used to produce hand sanitizer. And to the extent that you are doing that, the CARES Act waives the federal excise tax on distilled spirits used for or contained in hand sanitizer produced and distributed consistent with the guidance. So that is one that we've heard a little bit. We do have a lot of resources available. So at any rate, there's a kind of a lightning round of some of the other provisions, tax provisions, and cash flow preserving provisions that were part of the CARES Act. So just wanted to make sure we went through all of those.
Sure, and outside of those kind of the things available, via the government or different accommodations there, we're seeing a lot of breweries that are getting creative to generate additional revenue or to continue to generate revenue there. Whether it's depending on your location and depending on the regulations in your state, we're seeing direct to consumer sales, the to-go package sales, curbside pickup, making sure to practice that social distancing. Some places are allowing even home delivery that maybe didn't allow that before, the different distribution channels that they're seeing for their package sales. And we also see a lot of breweries are offering special deals on their merchandise, things that you can do now as a consumer to assist a brewery. Buy a gift card. Maybe you can't go out to the brewery right now and sit down and share a beer with your friends, but get a gift card, and hold on to that for when we can go back and visit our favorite breweries there.
Yeah, Tim, there have been a lot of great responses. And frankly, in conversations we've had with breweries over just the last week or so, it's been amazing, the community support for the craft breweries, that how much sales are continuing, where people are coming in practicing social distancing, but coming in and picking up packaged beer to go to take with them, buying it directly at the breweries. So again, the community response has been outstanding. Certainly not everybody is going to fall into that situation where they may not have had the ability from a package standpoint. But certainly brewers are trying to be as creative as they possibly can to generate whatever sales they can, and everything they do in terms of generating that cash flow is going to help them. They'll live to fight another day.
Right. Now, Pat, we've shared a lot of information here. Can you give just as maybe one or two real world examples of what breweries are and should be doing with this information?
Yeah, well, I think that we mentioned for the vast majority, the government through the Paycheck Protection Plan is basically offering to pay your employees for you to cover their cost of employment, and so to the extent that you do that and comply with the provisions, that becomes a forgivable loan. So I guess almost all of our breweries and small business clients are pursuing that. That seems a no-brainer, slam dunk. Everybody ought to be considering doing that. Obviously, to the extent that you've got employees that need to take some sick leave, or at home caring for kids that are home from school or other things, again, full credits to offset some of those leave amounts. So again, I encourage everyone to take advantage of those. These net operating loss provisions, and particularly with the pass-through entities, we're seeing that if you're a brewery that started up sometime in the last 12 to 24 months, it's fairly normal to have some operating losses at the entity level the first couple of years. And if that is the case, and you're 2018 or 2019 and getting going, and you're a pass-through entity, that should flow through to your personal return. And on your personal tax side, then those losses can go back potentially to 2013 or 2014 when you had a regular day job perhaps and were paying some taxes. So again, that's another way to access cash. Slam dunk, it should be a no-brainer. Everybody should pursue those. Just a lot of good provisions in these bill. We would encourage everyone, and I probably should have led with a disclaimer that all of the information that we've included and discussed in this presentation is general in nature and should not be relied upon in providing tax or legal advice without independent research and analysis. Tax and legislative policies are ever evolving, especially in this area. So current updates to this information and analysis and discussed in this presentation should be considered. This material has been prepared for information purposes only, is not intended to provide, and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. So, everybody's situation is going to be a little unique, Tim. So, absolutely, these are general topics here. There are a lot of things that I think are going to have very common application for all the craft breweries, but you'd certainly want to reach out and get personal advice based upon your personal situation.
Pat, Terry, thank you so much for sharing your expertise on this very sensitive subject. We know people are watching this, brewers are watching this, and our positive thoughts go out to all of our brewery friends. We know this is an extremely difficult time for many businesses, and I'm doing my best to support them. I can tell you that. I'm drinking plenty of beer here as I'm quarantined and social distancing. So I'm trying to do my part to support the industry out there for sure. Well, Pat, how can brewers find out more about these developments that are affecting them?
Sure. We have at www.wipfli.com, wipfli.com. As soon as you get to our landing page, there is a COVID-19 resource center, which is being updated throughout each day, real-time developments, white papers, webinars, and other recordings to review developments that impact manufacturers and small and emerging businesses. So go to wipfli.com and you will see that resource center on our link. We really encourage you to reach out to us as you encounter questions that you need assistance with. The entire environment is evolving quickly, and we will keep addressing these issues that surface and share our insights for the industry, our clients, and our friends.
Excellent. Well, thank you again, everyone, for tuning in and listening to this episode of Hops and Ledgers, covering the business of brewing, brought to you by Beer Guys Radio and Wipfli LLP. You have a great day. Cheers.